Millionaires are made when the stock market crashes. Famous billionaire Warren Buffett once said, "The bigger the crash, the bigger the opportunities," especially if you can stay greedy when others are fearful. Right now, Trump's aggressive push for renewed tariffs is shaking up global markets. And while most investors are running for cover, the smart money is quietly preparing for one of the biggest wealth transfers in modern history. These aren't just headlines, these are signals. Every time tariffs go up, certain industries get crushed, but others explode with opportunity. In 2025, we're not just looking at a trade war. We're staring down a complete reshaping of supply chains, manufacturing, and tech innovation. From AI-driven chip makers to domestic energy and blockchain infrastructure, the next wave of millionaire investors will be the ones who understand where the disruption creates growth. In this video, I'm going to break down exactly how this shift is happening, which sectors are about to pop, and the specific stocks that could turn today's fear into tomorrow's fortune. If you're tired of sitting on the sidelines while the market moves without you, now's your chance to make bold, informed decisions. But before then, kindly help this video to get 500 likes, share, and subscribe to the channel for latest market insight and opportunities. Our fist pick is SoFi Technologies. SoFi, a digital-first financial platform, has remained one of the most searched and talked about fintech stocks, and for good reason. The company straddles lending, banking, and investing, aiming to become the Amazon of finance. Despite a recent 10.2% dip in share price over the past month, the long-term fundamentals, strategic innovations, and macroeconomic positioning paint a more nuanced picture that investors shouldn't ignore. In the past 30 days, SoFi shares have lagged behind the broader S&P 500, 5.1%, and even underperformed its financial miscellaneous services industry, 7.2%. This short-term decline has been driven by broader market volatility, fueled by trade tension fears and interest rate uncertainty, rather than any SoFi-specific red flags. Zacks currently rates SoFi at a number 3, hold, reflecting tempered near-term expectations. But here's why long-term investors might still want to keep SoFi on their radar. Despite its short-term dip, SoFi continues to deliver on top-line growth. Q1 2025 revenue is $764 million, 24.4% year-over-year, beating the $679 million estimate by 8.8%. EPS 0.055 versus $0.02 year-over-year, 50%, beating estimates by 25%. Last 4 quarters. Beat EPS estimates 3 out of 4 times and revenue every time. While earnings estimates have been trimmed slightly, this may be overly conservative. Despite these slight downward revisions, the earnings trajectory still points strongly upward, a key signal of SoFi's operational momentum and efficiency gains. SoFi is trading at $13.27, just shy of the analyst consensus price target of $13.82, suggesting a fair valuation in light of projected earnings and revenue growth. However, SoFi is currently graded F in terms of valuation by Zacks, meaning it trades at a premium compared to peers. But should this deter investors? SoFi is a growth story, not a value play. Premium valuations are commonplace in early-stage growth companies with strong fundamentals and an expanding market. Think of it not in terms of traditional multiples, but through the lens of total addressable market, TAM, user acquisition, and revenue scalability. Here are the strategic developments and catalysts. 1. Smart Start Refinance Option. This product allows new borrowers to lock in interest rates while deferring repayment until full-time employment begins. This is a targeted growth tool, especially relevant as federal student loan forgiveness options tighten under new regulations. Student loan origination volume surged 59% year-over-year in Q1 2025. Expect continued momentum here. Private market funds for accredited investors. This opens up a higher-margin, wealthier clientele base. It also diversifies revenue beyond traditional loans, reducing dependence on interest income. Embedded finance via B2B platform. SoFi's banking-as-a-service model is gaining traction. This is akin to AWS in cloud, not as flashy but highly scalable and sticky. By offering white-label payment and lending infrastructure, SoFi is well-positioned to benefit from the next wave of fintech integrations. SoFi's land and expand strategy, where customers are onboarded via one service and gradually adopt more within the ecosystem, is working. More products per user equals higher LTV, lifetime value, drives organic growth via referrals and network effect, increases switching costs for users. This strategy is becoming increasingly efficient as SoFi scales. evident from the projected EPS expansion of 80 to 87% in financial year 2025 versus revenue growth of 24-27%. That delta underscores powerful operating leverage and economies of scale kicking in. The three-year total return is plus 153.5%. One-year performance is plus 121.5% versus industry AVG 32.9%, while projected revenue by 2028 is estimated at $912.2 million, which will see the annual revenue growth forecast of three-year hit 16.9%. SoFi isn't just riding the fintech wave, it's helping shape it. Despite macro headwinds and the risk of near-term pullbacks, the trajectory points up. We can't highlight the potentials of this company without the risks and red flags. Valuation risk, trading at a premium, vulnerable to sharp corrections in bearish markets. Regulatory uncertainty, especially around student lending, federal forgiveness policy, and financial product scrutiny. Execution risk by scaling too quickly without refining operational efficiency could compress margins. Given the recent price pullback, 10% in the past month, and earnings estimate downgrades, SoFi may face near-term volatility. A wait-for-pullback strategy might be prudent for momentum traders. For long-term investors, this is still a compelling growth story. SoFi is expanding its ecosystem, diversifying revenue, and consistently outperforming on revenue and EPS. For investors with a 2 to 3 year horizon, this could be an opportune time to accumulate during weakness. SoFi Technologies is no longer just a student loan originator. It is building an integrated financial services platform with growing consumer and B2B arms, strong brand equity, and a scalable tech foundation. With digital native Gen Z and millennials now representing the largest slice of the U.S. consumer base, SoFi is positioned at the intersection of fintech innovation and generational financial shifts. Let us know your thoughts in the comments. Do you think SoFi is ready to break out or headed for consolidation? Like, share, and subscribe for more real-world investing insights. Palantir Technologies Inc. ticker PLTR. This stock is once again in the spotlight, driven by escalating geopolitical tensions and the broader market's renewed focus on defense, security, and artificial intelligence (AI). With shares rising over 3% on June 13th following Israeli missile strikes on Iranian nuclear facilities, investor attention has sharpened around Palantir's role in global intelligence, data analytics, and national security. But is PLTR simply a short-term beneficiary of political unrest? Or does the company offer long-term value rooted in transformative software, robust earnings growth, and deep government ties? Let's break it down. Palantir builds data platforms used by governments and enterprises to make sense of massive, often chaotic data streams. The two core products are Palantir Gotham. Designed primarily for defense and intelligence, Gotham allows operatives to uncover patterns in large data sets and act on real-world threats in real time. It's widely used by U.S. military, intelligence agencies, and allies. Palantir Foundry. This platform is built for commercial users and acts as a centralized operating system for enterprise data. It enables businesses to integrate siloed data and drive decision-making with precision. A newer innovation, Artificial Intelligence Platform, AIP, aims to blend these tools with next-gen AI, allowing clients to operationalize machine learning models faster and at scale. The most recent geopolitical unrest has triggered a sharp uptick in defense stock demand. As nations react to rising global instability, particularly in the Middle East, investors are gravitating toward companies positioned to benefit from increased military and intelligence spending. Palantir, with decades of experience in counterterrorism and military-grade software, fits this profile. But beyond short-term catalysts, Palantir's appeal stems from broader structural shifts, growing defense budgets across NATO and allied nations, enterprise demand for AI-enabled data systems, high-margin software as a service, SaaS business models scaling across industries. Palantir currently trades at a forward PE of over 200x, and its enterprise value to sales ratio, EV sales, is hovering around 72x, staggeringly high by software industry standards. For context, peers like Snowflake or CrowdStrike often trade between 20x and 30x EV sales. This means Palantir must continue to grow aggressively, expand margins, and dominate the AI data software race to justify such lofty valuations. Analysts remain divided. Some see a disruptive AI giant in the making. Others warn of a correction if execution falters or geopolitical premiums fade. While Palantir's government contracts provide stability, the real upside lies in its commercial expansion. The company reported a $1 billion U.S. commercial revenue run rate, with total commercial contract value growing 239% year over year. Its AIP product is increasingly seen as a key differentiator in enterprise AI adoption, especially as organizations scramble to implement large language models, LLMs, securely and at scale. If Palantir can convert its AI advantage into broad enterprise penetration, its addressable market could balloon in the years ahead. Here's some risks to watch out for: sky-high valuation, dependence on U.S. government, uncertain international expansion, AI hype versus real results. Technical levels to monitor: support, $97, $83, and $66. Resistance, $125 to $135 range, recent highs post Q1 earnings. Traders may find entries near support levels, but long-term investors should focus on fundamentals and earnings trajectory. Palantir a buy? Palantir is one of the few companies uniquely positioned at the intersection of defense technology, AI infrastructure, and deep data analytics. Its platforms are sticky, mission-critical, and increasingly relevant in an unstable world, but the market has priced in perfection. At its current valuation, Palantir needs to maintain strong revenue growth, expand its commercial footprint, and show tangible AI-driven results to sustain its share price and justify any upward movement. If you're a long-term investor with high conviction in AI, national security tech, and scalable data infrastructure, Palantir may be worth holding or accumulating during dips. However, if you're sensitive to volatility or valuation risk, it may be wise to wait for more favorable entry points or confirmation of its AI platform's success. If you're looking for a pure-play quantum stock with commercial traction, real government contracts, and bleeding-edge tech, this one's for you. Hit that like button and let's dive into D-Wave Quantum. Ticker symbol, QBTS. What makes D-Wave Quantum, QBTS, special? D-Wave Quantum isn't just another futuristic tech company pitching vaporware. This is one of the few players in the quantum computing space with real systems, real clients, and real revenue, and they just launched their most powerful machine yet. Most quantum firms are chasing universal quantum computers, an ambitious goal that's likely years away. D-Wave took a different route. They're laser-focused on quantum annealing and solving practical, real-world optimization problems today. From logistics optimization and financial risk modeling to AI training and even drug discovery, D-Wave's quantum systems are already being used to tackle some of the world's hardest computational challenges. If you're building a tech-forward, future-focused portfolio, QBTS offers exposure to a fast-moving field with limited direct investment options. You're betting on a real working quantum product, an expanding customer base, tailwinds from governments and enterprises racing to adopt quantum. While speculative, D-Wave Quantum is one of the purest plays on commercial quantum computing you can invest in right now. The future is bright, and SoFi, Palantir, and D-Wave Quantum present opportunities. But this isn't financial advice. Do your own research. Thanks for watching. See you in the next video.